Great. Well, cool. Thanks for coming, Edwin.
Thanks for having me.
I guess a good place to start is maybe you just tell us a little bit about your path to digital assets and what led you to build One Conto.
Yeah, thank you. So my path to digital assets, like most people, that came when I came in late 2017, early 2018, is Bitcoin. I was at Wells on the asset management, sales, and trading side. Um, Read the white paper, and it fit very nicely in my hatred for the Federal Reserve at the time, still today. Uh, Jumped in, bought some Bitcoin, tried doing cross exchange arbitrage on various assets, and learned about uh, how poor the pricing was in the market. So hooked up with my brother, started a started our business One Conto. Originally, we were focused on cross exchange arbitrage and uh, improving execution quality for broker dealers in the space. Lo and behold, in 2018, early 2019, there weren't many broker dealers, so our clients ended up pushing us towards stable coins and on off ramping, which is where we are today. And we've built up a deep liquidity pool that's multi-fiat and focused now more so on cross-border fiat settlement.
Cool. So, maybe you could just explain in the traditional finance world what actually happens behind the scenes with the cross-border settlements and how that works, and then maybe talk about how stablecoins does it differently.
Yeah, so if you're swiping your card cross-border, um, there could be as many as 47 different participants that are a party to that transaction. So I'll skip that version of it. But simplicity, in a simplistic view, let's say you want to wire money to yourself in Europe, right? Uh, your bank account gets debited the dollars. The bank does an FX charge that for retail users typically around 2.5% spread, or the fee is effectively 2.5%. For a corporate user, it's not much better directly at the bank. Um, Depending on which bank you're at, they will send your money, which is really just instructions, to a correspondent bank that will then forward it to either another correspondent bank if they want to get paid for it. They'll hold on to it overnight to earn interest overnight. That's their net interest margin. And then eventually one of the correspondents will deliver the funds to your European bank. That process can take anywhere from same day, if you have a good relationship with your bank and they prioritize your business, or up to 5 days or longer if they don't. Um, Regardless of how large or small your account is, we know international corporations that routinely see the high FX charges and the 5 day wait time. And during that entire process, you have no idea where your money is. It's effectively a black box, and no bank in the chain can actually tell you where it is other than the fact that it's in process.
Okay, cool. I'm just wondering for, impacts today of stablecoins, where do you see like the most impact being, within the institutions or like business to business, business consumer? Where are they making an impact?
Yeah, it's streamlining that process to near instant or near real time. So local rails being used on the in and out of the fund flow, and then providers in between using stable coins to make it streamlined. Um, so what we do for companies is we'll receive dollars on the back end. We're trading into and out of stable coins to get to the source or to get to the destination fiat, and then settling via local rails, whether that's PIX in Brazil, SEPA in Europe, or SPAY in Mexico. It doesn't matter. But that's cutting out all of the delays. And with that, we actually have visibility into where the funds are the entire time, right? So we know where it is once we receive it, and then once we send it, we can show that to our client.
And what's like the composition of volume of remittances? Like, is it people sending money home to their family, or is it like countries buying oil from one another, or like what do you see today that's being actually settled, like real economic actions?
So we see a little bit of all of the above. We're seeing a growing use case in commodities being settled, and then what's historically called getting the bananas off the boat, right? So having stable coins as the means of transfer allows you to clear shipments and transfers faster. The people conducting business in stablecoins aren't necessarily holding them overnight or as like a core portion of their treasury. So they're still off ramping. So as a U.S. entity with U.S. banking rails, we're seeing mostly the off ramp side. So let's say a company's in Africa and they have to send their earnings back into the States. They are going from the local African currency to Tether, then Tether to USDC, and then bringing us USDC or Tether, depending on the market environment. And we're delivering dollars onshore. We also see like money out of India, so repatriating funds out of India into either dollars or Tether. And then there's always the persistent use case of using stable coins. The ones that are mostly holding stable coins are using it as a bank account. So a way to get away from inflation in the local currency. So that was Argentina, but also largely Africa right now. So we're seeing a lot of inflows to those areas as well.
Do you have like a more fine-grained example of an India remittance? Just curious, like, is it private wealth? Like, is it families just trying to send people money overseas, or
no?
I don't know. Do you have a view into that?
No. So our view,
or do you have speculation?
Two things. Our view, we're typically working with aggregators of funds, and we're disassociated from the end users.
Got it.
So by the time it gets to us, I mean, I have an idea of what my client's business is for all the applicable regulatory requirements, but I can't tell you exactly what, why somebody did something at the end of the day. Generally, for the India flow, it's to get it into Tether is what we're seeing. And there's a big demand for that coming out of India. And could be currency. If you look at the chart, it's just down. Not as bad as some currencies, but that's one. And then it's also for international payments and suppliers. Moving INR out of the country is costly and slow. So moving it into Tether first allows it to transact a lot quicker.
Would you say that the use of Tether is impacting the value of the currency, do you think? Or is that just completely, that's just not even related?
I wouldn't say that Tether is having a negative impact on the INR. I think India is doing a good job themselves.
Sure.
Having a negative impact on the INR.
Yeah, okay, great. So I'm also curious, you mentioned Tether, USDC. How are like institutions looking at, what stable coin actually gets used? Do they have a preference? They prefer using, there's even like Pax stable coins or some others I'm not even thinking about. Like, so how do they look at like, we're going to use USDC versus USDT only? Do they not care? Or like, what's the institutional sort of like view of it?
Yeah. So what we see is the degree of caring it mirrors their regulatory cover, right? So if you are a regulated bank in the U.S., you are going to only use USDC. And you will not touch Tether. And then you have offshore entities that view that Tether's position with the regulatory environment as an advantage, right? So the fact that they're not as close to the U.S. government as a reason for using Tether is a natural distrust of America that some of these countries and their citizens have.
Is Tether a U.S.-based company, or is Tether organized overseas?
Organized overseas, believe out of El Salvador.
Sure, okay. That makes a lot of sense. Yeah.
I believe that's where they're organized.
Now, also curious, when they're doing these settlements, are they concerned about privacy? Are they using just Ethereum as the settlement layer? Do they worry about that at all? Is that a concern that it's all public, or do they not? Doesn't really matter.
USDC volumes mostly on Ethereum, some Solana. Tether is 90% on Tron, 10% on Ethereum. But in all of those instances, they're public, right? So yeah, there's been no real push that we've seen towards private and anonymous blockchains. And that also, I think, causes issues for banks and your larger payment service providers or regulated entities. The U.S. government in particular hasn't looked too kindly upon anonymous means of transmission.
Yeah. Does your use case allow for like fees on Ethereum to be very high and everything still works? Do you look at like other chains where the fees are lower, like the gas costs? Yeah. I know fees are low on Ethereum now, but they weren't
historically low.
Historically low, yeah.
In what was it, 2021? like what that was, I think the last time, yeah, we passed the fees on when that happened.
Yeah,
Um, but outside of that, we just bake it into spread,
got it.
right? So I think it costs $140 or more at times to transmit on Ethereum. Um, the market very quickly moved to Tron for Tether during that time, and now we're at a point where it's actually more costly to transmit on Tron than it is on Ethereum. Like Ethereum's pennies,
Interesting.
and Tron is like $3 to $4 per transaction.
Interesting. Not realize that. Um, so I heard from some of my friends who went to the New York conference. I forget which one it was, but it was a lot of bankers, and they were very interested in all of this. What do you think like changed that got them suddenly really interested in stablecoins? Because it seems to me they're all talking about stablecoins. I think Visa,
Yeah.
whatever, just came
Yeah.
out with a stablecoin. Mastercard maybe. PayPal has been using PayPal USD. So what's like what was the catalyst for that?
Genius Act and Clarity.
And why? Like, what are? I don't think a lot of us know what are inside of those. So, like, what kind of do you know what the provisions are in there that maybe made it more attractive? Because overall, I think it's just like, yeah, now there are some rules, but like, what are those rules? Like,
Yeah. So the first thing with banking in any heavily regulated industry, the easiest thing to do is say no when you have an easy question that you can point to, right? So with banks in particular and other regulated entities, it was okay. Well, what's the regulatory status? And I think stablecoin regulation is shaping up how most people were treating it anyway, right? So you do have to AML, you do have to KYC, you have to follow effectively the same rules and regulations when transmitting and working with it as you do with regular dollars. Um, the biggest one, I believe it was Genius Act, removed the one-to-one asset. So like if I had 100 USDC on my books, my balance sheet, I needed $100 to go alongside that. Um, that's very capital inefficient, and no real entity would want to adhere to that. You can't do that. And then the second is it gave the regulatory. It's really, I view it as a stamp of approval, right? So if a bank or a large payment service provider can sit behind and say, well, it's regulated, it has this stamp, it's meeting these reporting and investment needs, and it is backed one-to-one. It's effectively more backed than our dollars are backed, right? That it just makes it easier to move things internally at these companies. I think we've seen that over the last 2 years be a big push, and all the conferences are banks are getting into stablecoins. You have BVNK getting bought, Bridge got bought by Stripe, right? So you see the legacy fintech and legacy financial infrastructure companies acquiring and really getting exposure now.
do you see a world where all banks have their own stablecoin?
No.
And why not?
The Wildcat banking era wasn't that great when we first did it, and I think that every small regional and community bank would just cause a lot of turmoil and discounts and a lot of uncertainty. I think that it's more likely the big four have their own or consortium coin that allows for the smaller regional banks to recognize it as a dollar. It's effectively checks, right, at that point. And I think that's the way it will likely go. I don't think there's space for 4,000 different coins.
Yeah, great. So a little bit about One Quad. So like, where do you sit in the stack, right? Are you guys a liquidity provider? Like, do you have an API that someone integrates with? Like, how does it actually work?
Yeah, so we face the majority of our clients via OTC. Our average order size is 2 million, but routinely do $20 million tickets. We do offer API web app access as well. We're coming out with automated transactions, so automated trading settlement just by sending to an account or a wallet address, as well as integrated banking. So moving up the services tier. But currently today we're closer to a liquidity provider and cross-border payments FX desk.
And what's been the hardest part of building the business today? Like, what was the most challenging piece of it all?
I would say Operation Choke Point 2.0 was.
And what was that for everyone that doesn't know?
It's where the government whispered in banks' ears and told them to shut down money service businesses at large, especially those that touched digital assets. So yeah, I mean, having to change your bank every so often uh, was not fun.
And that was you guys as a business. Your bank
Yeah,
account keeps getting shut down. You have to change banks.
yeah, and it wasn't like anything that we only we were exposed to. It was very common for virtually everybody in the liquidity space in particular, because it's high. I mean, we settle within an hour, right? So it's high velocity. Um, but yeah, you know, pretty much everybody had to change their banks or on a periodic basis, and it wasn't by their choosing to do so.
So with such fast settlement, like 1 hour, and such finality, have you experienced any issues where there was a like a intervention to call the money back, but it was gone? Like what would happen in that case where money was moved inappropriately and there was a order to like halt it? Because in traditional finance, there's typically a delay,
Yeah.
a period of time. So have you run into any of those instances, or has compliance sort of caught all that before it goes across?
No, we have not run into that instance. So we deal with immutable as best as you can on the fiat side of things, immutable ways of transferring, right? Like we don't accept ACH deposits, for instance, because they're easier to claw back than a wire. Um, but we also put clients and counterparties through a very rigorous onboarding process that you can suss out bad actors, which is effectively the only person that would try to do that is a bad actor, before they even get to their first test trade.
So you've worked with institutions. Anything surprise you about when you're engaging them? Like, were there any things you were surprised about, I guess, just in general?
Um, no, I mean, coming from the institutional side,
Nothing.
nothing.
What do people who are just building in the stablecoin space, they don't really understand a lot of the regulations and things. Like, what would your recommendations to them be who are trying to build stablecoin products? They're getting started today because we have a lot of developers. So
Uh, Take a look at the regulatory, spend some time, the AI models understand it very well now. Um, Pressure test what you think is reality against what actual reality is. Because we do come across a lot of startups that try to use us for price, like how to price their product, how to structure their product, and some of the regulatory schemes that they think they fall under, which they, from my eye, they clearly do not. And we're not in the business of providing regulatory guidance, but we do try to point them towards resources. Um, yeah, if you're in the U.S., operate via FinCEN and any state money transmitter licensing. Like, become very accustomed and understanding what those are. If you're in Europe and trying to build in Europe, they are very serious about MiCA. So read that, understand that, go through the efforts there. And similar in Brazil's another one that's really become uh, firm or clear on their regulatory. And then Mexico, it's always around the AML. That's the biggest concern in Mexico. So just making sure you have all your ducks in a row.
cool. So what do you think cross-border payments is going to look like in 5 years? Like, will there be no traditional finance settlements? Will everything be totally stablecoin? Is that a long enough timeline to see that transition, or will there still be
Yeah.
yeah?
So I think the way that the regulatory is shaping up in the U.S., that stablecoins probably won't be the end asset that you hold. If it does make it through where you can earn interest on them, then every bank that ends up receiving it has an incentive to burn it or sell it, so that way they can get fiat and perform their core function of earning interest and lending capital out. Um, I think for the end user, they already think for most part, like when they swipe a card or send money on via Revolut or Wise, that the money moves instantly. At the end of the day, it actually will move much closer to real time than it does today. And larger corporations, I mean, we're already seeing it today. I think the institutional stablecoin sandwich or a variation thereof will become the de facto standard, whether they implement it themselves or the banks work with somebody like me or themselves and implement it. Uh, it's just much quicker. And getting every fiat system onto a unified network. Swift was the best effort at that, and it has all these problems that have yet to be fixed. Um, I don't think every country's central bank is going to work together well enough to supplant the stablecoin use case.
Cool. I had one more question here. Just gotta like bring back my notes. Lost my place. Uh, yeah. So corporate treasuries, crypto treasuries are a big thing. But just in terms of corporations that have been like buying a little Bitcoin, corporations holding digital assets, do you think stable coins play a role in that? Will corporations hold stable coins in their treasuries? Do you think that that's an advantage or?
If you can earn interest on it, probably not. Now there are platforms that you can go and they'll manage your stablecoin holdings similar to a money market fund, right? To try and generate reasonable yield of 5 to 8%, right? Not the 20% Terra uh, yield targets of the last cycle. Um, but I think that they'll hold enough. Let me put it this way: we work with payment service providers that do a large amount of stable coins. They internally net and then they off ramp or on ramp the imbalance to settle client flow. They're not holding 5%, 10% of their portfolio, their cash position in stable coins. They keep it in the bank overnight. There are some, like Link is a product that's trying to go around that, where it's effectively a tokenized money market fund, which is similar to a sweep account, where your cash balance gets swept into money market to earn yield overnight. So I would say those hybrid products treasuries might use, but at the end of the day, that's a broker dealer issued and controlled, falls under SIPC, and is more akin to a regular sweep account than it is USDC or Tether.
So another really popular use case for stable coins are vaults.
Mm-hmm.
So like, I'm wondering, do you see any use case for vaults by institutions with their stable coins? You see them being a vault user. We have things like Morpho where you can deposit stable coins and earn yield. Do you think institutions are going to get involved in that space at all?
I think so. There's a few platforms that are built on top of things like that. I think they are seeing uptake. But I don't know if your corporate treasurer is going to venture that far out. Like if you put your CFO hat on, right, and you're a head of treasury, there's a lot of risk in throwing your money into an unregulated DeFi pool to try and earn a couple extra points, right? Whereas it's a lot safer and probably better in the shareholders' interest if you place it at a broker dealer for the money market fund. Just especially, I know it was brought up audits and legal and regulatory. The less questions you have to answer around why did you try to get this incremental return when you could have been effectively 100% safe and secure overnight, with no chain risk, no smart contract risk, no accidentally funding terrorists or Hezbollah or something else. I think we're a ways away. And when it does get there, it'll look like a kind of a walled garden where your broker dealer is effectively doing the same thing, but on chain.
Got it. Yeah, so just a couple of questions wrapping up. Do you see for founders and builders any major opportunities in the stablecoin space, like where there are maybe unsolved problems or places where builders could work on?
Unsolved problems. Well, most of the problems right now, I would say, are the final regulatory hurdle to get banks fully involved, allowing stablecoins to sit alongside, but showing a problem I know banks will eventually solve or look to need to be solved would be their stablecoins represented alongside their bank accounts in various currencies and various stablecoins, so delivering a unified, holistic experience, and abstracting away all of the complexities of stablecoin usage. Uh, Early adopters, yes, will still be able to bank themselves and I would say, fulfill the original ethos of what crypto allowed. But, you know, my mom, my grandmother, and the vast majority of the public probably wouldn't feel too comfortable being 100% responsible for losing their own money. So I think abstracting away the complexity and making it safer or easier to use is a huge opportunity.
Got it. I'm just curious. So if you're taking the skeptical side for a minute, what's the major arguments against using stablecoins?
In the first world, like in America and Europe and other advanced economies, the end user already thinks money moves instantly, right? So 1970s tech, but there's been a lot of very successful fintech companies that have built on top of that. And again, abstracted away how awful the underlying infrastructure is to deliver a good experience that, you know, doesn't really interfere with anybody's life outside of certain use cases. Um, I think the way you get around that is allowing yield to be earned on stablecoins. Um, I think that will give new fintechs a big opportunity to provide a better banking experience that is effectively on chain, unbeknownst to the end user, right? They could advertise competitive rates that the traditional banks are, I think, what are you getting, like 0.1% if you're lucky still, right?
Depends, yeah.
But
is it checking? Is it savings?
And even then, it's like insulting the rate they're giving you on your savings. But if you're able to put it on chain, and then if Circle ends up giving you part of the money market fund yield, you can, as a developer, right, you don't have the same infrastructure cost that JP Morgan or Wells Fargo has, and you can pass on a lot of that yield to your users. So I think that's what's required to really move things forward here. Overseas, the remittance and getting money out of countries, so like remittance money in and then using it as an on-chain bank account, removing currency inflation issues as a hedge, and then like multinational companies we see a huge use case, multinational corporates wanting to get out of, say, Nigeria, Ghana, Kenya, and South Africa back into dollars or euros. So that's something we're working on a lot. ZOF as well, moving those funds into both euro, dollar, and stables. So I think that use case internationally is already there, and that's where most of the adoption is. But onshore, I think you need a big carrot, like yield.
So my last question, then we'll open up the audience, is what are you most excited about in the next 12 to 24 months in the space? Doesn't have to be stablecoin, just crypto in general.
Crypto in general. Well, I would say, first I think we're getting closer to the bottom of this cycle, so I'm excited for that.
Sure, everyone's excited about that. Yeah.
But no, in stablecoins, I think that again, just from where we sit, I'm excited to see where cross-border is going. I think that's, outside of the inflation hedge, I think cross-border is another clear product market fit. And I think that one is hitting, we're seeing more of it now and through the next year. And depending how yield shapes up, if I go out 2 to 5 years, I would say it's the onshore. And Stripe's doing a lot there, right? Stripe, with they're effectively USDC and all of the subsequent coins that they support, the stable coins that they support, they manage and treat as one-to-one. So the merchant doesn't have to think about converting it or doing anything. They can just accept it alongside their credit cards and debit card options. So I think you'll see a lot there. But again, you need the user to hold it. So I think if we get the yield, I'm very bullish on individuals actually holding stable coins.
Great. All right, cool. Well, that's my last question. I guess we'll open it up to the audience. Does anyone